And we're good.
Scott, thanks to you as well for helping close out this excellent conference.
Thank you, Dani, for having me. Hi, everybody.
So as this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment, because we entered 2025 saying this was the year of private capital reemerging, of animal spirits, of deal making, and then April 2nd happens. It feels like we did the same thing over again in 2026, and then it's AI, credit fears, and now war to contend with. Scott, can 2026 still be the year of M&A, of deals, of private capital's year?
I think it can be. You're right. There's a bit of a deja vu element going on. We came into last year and this year with expectations capital markets would be strong, M&A environment would be robust, and it was last year for larger transactions. A lot of what we do, the $1 to $10 billion deals, was less robust. I think people were waiting a little bit to get into this year to start to sell some of their companies. It still could be the case that that's available. This is a moment in time. We'll see how long we're here. It's far too early to call. As you know, the tariff concern last year lasted for a couple months, and the people processed it and started to move on. We'll see how long this lasts. This could have more duration to it, though.
Well, what happens if it does have more duration? And I should just say that KKR has been out in front with monetizations, but the industry as a whole is still experiencing that indigestion. What happens if it continues?
Well, I think you got to step back. The way we look at it is you got to go back in history a little bit, right? So we came out of the financial crisis as an alternative asset management industry. The whole space was roughly $3 trillion. Right, so we've seen growth now from $3 trillion, and that's excluding hedge funds, to about 15 from the course of 2010 to 2025. Okay, that sounds like a lot of growth, but it's about 11, 12% a year. And so we went through this period of time, 2010 through 2020, pretty benign environment, right? Rates were low, inflation was low, multiples were going up. We said to our firm, do not confuse a bull market with brains. Right. We saw a lot of growth during that period of time. And you're right, 2020 to 25, pandemic, wars, inflation, rates up, tariffs. Very different period of time. And so what's starting to happen is you're starting to see the decisions that people made over the last 5 to 10 years become more clear in terms of whether those were good decisions. Our industry periodically over deploys. And that's what happened in 2021. People put a lot of money to work in 2021. And so to some extent what's happening now, and some of the noise I think you're hearing in the market, is some of those deals are now getting to their 5-year mark. They've got to refinance their capital structures. But not everybody's painted with the same brush. You know, this is a very US-centric dialogue so far.
Sure.
You know, for us, we have more than half of our investment professionals outside the United States. Right? We have learned these lessons, and I can say this with a lot of humility. We made the over-deployment mistake as a firm in 2006 and 2007. And so we learned, you got to be focused on linear deployment. It sounds boring, but if you have 5 years to invest money, do about 20% per year. It's a very low-tech chart to see how you're tracking. Don't over-deploy, don't under-deploy. Got to focus on portfolio construction, and critically, you got to be diversified. And there's nothing that kind of beats those three things. And what we found, I thought it used to just be my teenage sons, but it turns out everybody's an experiential learner. You know, people learn by doing. We learned these lessons a long time ago, and so I think where we're heading now is, you know, we've talked about K-shaped economy all the time. I think we're headed toward a K-shaped industry, where you're going to see a bunch of winners and some folks that have more lessons that they have to learn as they come out of this period of time.
But is everyone going to be like KKR, learn the lesson and go on, or is it a shakeout that's going to happen in this industry?
Far too soon to answer your question.
Okay.
I think there's going to be some consolidation. As sure as we're sitting here, there's some firms that will not be around. There's some firms that will do the apology tour and the apology fund. So the next fund will be 0.3 times the size of the last fund, but their investors will decide to give them another chance. How that breaks down, far too early to tell.
Is it a problem then, and I don't want to get into the complexities of war, but one of the outcomes of it might be higher inflation if energy prices go up. It did seem like kicking the can down the road might have been solved if we could have a meaningful rate cut cycle. If we don't get that, how does that change the industry and the ability of those that are currently learning the lesson to survive?
Well, I think we will see what will happen, and we're already hearing it from our limited partners and institutional investors in particular. They are consolidating their relationships with people that have been giving them money back, and people that have been performing on a relative basis. We did spend better part of 10 to 15 years a little frustrated because we felt that we were making better decisions in terms of through cycle investing. That was not apparent when rising tide is lifting all boats. It is now far more apparent today than it was even a few years ago, and a few years from now will be even that much more the case, hence this K-shaped comment. So I think what's going to happen is you're just going to see increasing dispersion in results, and not everybody's going to be painted with the same brush. So for example, in January, we sold a software company for 4.5 times our money. On Monday, we did a block trade in the public markets for one of our public names in the US. We have multiple businesses all across Asia. It was a very active monetization year for us in Asia last year. The benefits of being global and diversified and being thoughtful about deployment pacing through cycle investing and portfolio construction are going to really matter. And then there's going to be the have-not bucket. And we'll see. We'll see how people learn. We'll see if their investors are prepared to give them a chance to come out of it. And so over time, some of those will do well, as we talked about, and some may not be around.
By the way, underlying all this, and this is kind of where we started, it feels like there are 4 simultaneous existential shocks and risks happening right now, whether it be how AI transforms our world, fears over credit, trade fears continue to crop up, and it's now war too. What is an investment committee like at KKR right now? There must just be so many risks that you're having to grapple with.
We're very calm. I think we're actually enjoying this period. Okay, so you got to focus on what you can control. Markets, actually, let's go further back. Human beings, and therefore markets, hate uncertainty, right? It's absolutely the case. And it's also the case that a number of people, most people that are investing seats for a long while, have PTSD from the financial crisis. And so everybody's trying to figure out what's going to trigger the next big downfall for the space, for you name it, for the economy, for the markets. We don't see a precondition for that as we sit here today.
By the way, so just mean you would disagree with the Jamie Dimon comment? It looks like pre-2008 sort of environment.
Who knows? You need a lot of humility. That's not my job.
Sure.
Right? Our job is to invest for the long term and generate returns for the people that are counting on us. We need to think in 10, 15-year increments, right? So the investments we're making today, the companies we're financing today, people that refinance us out of those or buy those assets from us, they're going to be looking at years 10 and beyond. And when you kind of think in that way, oddly enough, it's easier to kind of get your head around what's year 10 look like than what week 10 looks like. And so what happens when you have volatility, it tends to be great for our business. And this is where people get a little confused. If you're a public market investor, because you invest, you think we do the same thing. It's a very different business. We have 118 billion of dry powder, right? And as we say to our teams, if you have 118 billion of cash in your pocket and nobody can take it away from you, when things get cheaper, that's called a good day, right? So to some extent, you kind of almost root for things to kind of get more reasonably valued, and then you can make some great investments. These tend to be very attractive vintage years for us. But I think we need to be really sober-minded about what's happening right now. S&P 500 is flat year to date.
Yeah.
It's up 18% last 12 months. Europe is up 6% year to date as we sit here. Asia's up 8%, even with the correction that we've seen in the last couple of days. So it's not like the markets have traded off, and credit is just shrugging this whole thing off so far. And that's what we tend to watch more than equities.
Well, are you surprised about that at all? That markets seem to be shrugging things off?
I think people are trying to assess, what does this really mean for the long term? And you have a challenge, right? Where's the money going to go? There's a lot of liquidity in the system. And so to the extent you'd asked me a week ago if we were going to invade Iran, or bomb Iran, what is that actually going to do to the markets? I'm sure most of us in this room would have been wrong. But in terms of how people are thinking about the long term, it is what it is. But for us, the equity market, we tend to think of as the more emotional friend you have that's a little Chicken Little in nature. And the credit market is the more sober-minded friend. When this friend gets nervous, that's when we get more nervous. We're watching this kind of move up, down, sideways so far. It's too soon to know.
I mean, that's one side, that there hasn't been a lot of reaction. Where the reaction has been is every single headline around private credit, whether it be redemptions picking up or just readership and viewership interest. We certainly see that on Bloomberg. Are you surprised about that reaction, about the reaction to private credit that just feels like there's so many eyeballs and such a microscope on it right now?
Well, it's a little bit to my PTSD from the financial crisis comment.
Yeah.
I think people are just looking for what is the next thing that is going to trigger something bad. And so I'm not surprised that it's getting focus. But also, let's keep in mind, right, the global capital markets are $300 trillion, about 50-50 debt equity. Fixed income's $150 trillion market. Direct lending, so when people say private credit, they're really talking direct lending, is $1.7 trillion of the 150. And so it's roughly 1%, a little bit more than 1% of the fixed income market. And then within that, this isn't a return thing. To get a fund down from an 8% return to 6%, you need to have a lot of defaults and very poor recoveries. And if you have that dynamic, I promise the last problem you're going to have is your private credit return being 5 or 6% versus 8%. You're going to have equities off a lot. You're going to have other issues in your portfolio. So it's less about returns. As ever, when you get in these moments, it's more a question of liquidity. And that's what people are anxious about.
Is that a fair anxiety to have about liquidity at this moment?
We don't see it. I mean, I think the vehicles themselves, forget whether the structure of these kind of private BDCs is going to work for the long term. That's not really the question. I think people know that it's private markets. It's actually in the name. When the reason that you tend to have issues with the markets more broadly is you've got leverage on top of leverage in the system, duration mismatch across wide swaths of assets that get revealed. From what we see so far today, that's not the case, but there's a lot we don't know. And I think that's what the market's nervous about, back to the anxiety and uncertainty. Right. And in the public markets, people sell first and ask questions second. And so we're kind of in this moment where people are nervous, and people that are nervous or panicking, they don't listen that well, and they're not often great at math in that moment. And so we're kind of in that moment in time right now. It's too early to call. Let's see.
Is it a problem, though, if fundamentals are sound, but you have this technical issue of redemptions and outflows? In other words, does something that become technical, is there a risk that it spills over to become a fundamental problem?
It would be, man-made in that instance, I would think. Sure. I think if people want to, kind of be very anxious and the markets more broadly trade off, could you come up with a scenario there's a wealth effect? But you would need such a big move in the markets. And I think one of the things we're seeing, there hasn't been a lot of new supply created in the capital markets. Part of the reason we haven't seen the credit markets move, there's not a lot of new supply getting created. There's actually supply being removed, and there's a lot of cash in the system. Same thing in equities. So it's a little about where's the money going to go? What else are you going to invest in? And you can sit on cash, sure. But in terms of if you want exposure to risk assets, people are looking at the market thus far as clearly and saying, okay, despite all the noise, this is pretty isolated. Software, AI, private credit, non-traded BDCs, very, very small part of the overall market in aggregate. The rest of the market's shrugging it off.
By the way, that idea that there's capital that needs to be put to work and there's limited supply, that's been pointed to as saying both credit and equity markets are mispriced. Would you agree to that as well? You're a close observer of credit markets, that there has been a little bit of skewing of valuations just because of the demand and lack of supply?
Oh, there's no question in credit in particular, spreads have been tight. Right there, it's back to the point. There's been capital, formation, but not enough product being created to absorb it. And so I think in the long term, I think we might look back on this period of time and saying this is healthy. This is a healthy rebalancing in terms of kind of spreads may move out a little bit. We'll see. Hasn't happened yet.
Right.
But if they move out a little bit, it'll be more back to where they were. Because remember, we're at kind of near all-time highs for most asset classes and more near all-time tights in credit spreads. And so people forget, not that long ago, last year the S&P went from 5,800 to 4,800. Now we're at 68, 6,900. A year later, the markets have moved up a lot. And when you have 3 years, we were talking about this morning with our partners, when you have 3 years in a row of 15+% return for the S&P, the next 5 years are pretty anemic in terms of equity returns. And you usually have a down year. We've had a great run in the equity markets and same in the credit markets. So taking a little air out of the balloon wouldn't be so bad. And for people looking to deploy capital, back to my point, volatility creates opportunity. So it's all about being ready.
Where's that opportunity right now? I know COVID, for example, when the market was frozen, KKR was one of the few that was out there to that point of linear deployment. In the volatility right now, where are you seeing those pockets that look attractive?
You know, it hasn't really shown up in size as of yet. So you're right. COVID, we were doing daily partner calls because we wanted to be ready. And we put a lot of money to work. But there was literally a 1 or 2 week period where the leveraged loan markets globally were on sale. And then it all came back. So you've got to be ready in the moment. You can't say, I'm going to go study this for 3-4 weeks. It's probably going to be gone by then. So we haven't gone to daily partner calls yet.
Right.
But we're getting close to weekly. So we're moving, but it's all about being ready. And so what you got to do is you got to create your shopping lists. That's what we're focused on. If something gaps out enough, where do we want to buy so that you can move fast? That's our work right now.
Can we have a peek into your shopping list? What might be on it?
Nope. I'll tell you after the fact. How's that?
Okay, fair enough. Come on, Bloomberg Deals, and tell us when it does happen. One purchase that we know you did is of Arctose. Can you just walk us through the thinking on that? Sports, secondaries. What was the moment that you decided these are capabilities that we want to add onto our platform?
Sure. Well, really, it comes down to people. I mean, we're in a people business, right? It's just the marriage of capital and talent. And so we have known Ian Charles, the founder, for a long time, decade plus. Liked him a lot. Did a deal with him, actually, secondary sale off our balance sheet. That's how we met. And, you know, sometimes you meet somebody and say, wow, really capable. You know, would love to have him as part of our team. It was that kind of a moment. Sadly, he worked somewhere else at the time, but he left that place and then started Arctose in 2019. So it really started with that observation. He built this sports business with his partner, Doc O'Connor, and then a GP solutions business alongside. And so we started looking at what they were doing, and because of our relationship, we just were comparing notes. You know, they would call for advice, we'd call them, get their thoughts on the markets, that kind of thing. And it just kind of developed organically from there. We as a firm, the one thing we do not have is a secondaries business. We looked at buying several and decided we couldn't find anybody that fit with us. How's that? So Ian and his team, their background is in secondaries. So the way we looked at it, the sports asset class, highly attractive, not just the franchises themselves, but real estate, securitizing media rights, lots of opportunities around it. GP solutions, which is providing financing and kind of business building help to firms that own have alternative asset management firms. That, as a business we know well, we've built our firm. And we cover 250 sponsors already through our direct lending and private credit business. So a lot of synergy there. And then they hadn't started building the secondaries business yet. So we looked at it as established business here, and then a big opportunity to build secondaries together. So that's how it happened.
Do you also have a shopping list for other pieces you'd want to add to the platform? Is there a sale among managers as well that, along with Arctose, you'd want to bring into the KKR fold?
M&A is hard in our business. It takes a long time. And for us, you know, it needs to kind of check a number of boxes. Asset class we're probably not already in any great size.
Right.
The team fit and culture fit have to be amazing. That was critical about Arctose, is the cultures are the same. And probably more permanency of capital. What you don't want to do is pay a big multiple for runoff capital that you have to replace. That's hard to find. Arctose, we bought a REIT platform in Japan. We bought our insurance company. So we've spent 13, 14 billion on acquisitions, but they're hard to find that have all of those attributes. So we're always looking, but I wouldn't say there's a long shot.
Say industry-wide, because there's been some talk of, are we going to start to see mega mergers? Do you think that consolidation will take in that form? You'll see a really dramatic shrinking of just the number of firms out there?
I think the mega merger between two alternatives firms is very hard.
Right.
You got overlapping LPs. You've got to figure out who's going to run the place. If you have overlapping businesses, probably a decent amount of negative synergies to think about. So I think you'll see more maybe BlackRock type acquisitions of alternatives players, and maybe players in different asset classes get together and create firms that have more diversity and kind of magnitude of overall AUM. But the two big firms getting together, never say never, but it strikes me as unlikely.
Do you think, though, that given what you're talking about, moving to alternative managers, only about a minute here, but that the landscape will just look very different in 5 years' time?
I think we've gone from 3 trillion to 15 trillion during a period of time where it was, for most of that, everything was going your way. I think we are going to see this space continue to adjust. I think, we'll have fewer players 5 to 10 years from now, but I don't think you're going to see a dramatic difference. I think you'll see it around the edges, and you'll see the big continue to get bigger.
All right, Scott, we're going to have to leave it there. Thank you so much for closing us out and joining us today. Everyone, please join me in thanking Scott Nuttall of KKR.